Welcome everyone, another great video. We're talking last minute tax mistakes and how to avoid them. We work with a number of retirees. We see these quite frequently.
Yes.
So we'll go through them and tell you how to avoid them so you don't make the same cost mistake. Number one, jumping right in. Mistake number one, not reporting all your income.
Yeah, that's the biggest thing. I mean, if you hit in that retirement saying beforehand, if you were working, you got one T4 maybe, you got an RSP contribution slip, boom, you're done.
That's it.
Probably file at the end of February. Nowadays, CPP, OAS, you might be getting money from non-registered investments. You may have part-time work. There's RIF withdrawals. You can get a variety of different tax slips. So not reporting all your income tax slips may be something that you do because you're not used to it yet. That's one thing that you have to take a look at. In retirement, it may take a year or two before you figure out exactly which ones you're going to get. So that's always a big thing that you need to deal with. And the investment slips can really be a challenge depending on how many you get. So, I mean, we'll do a deep dive in that later, but those are some of the quick non-reporting issues that you may have for why you're avoiding taxes.
And for many retirees, it is a change.
Yes.
As you mentioned, if you just get a regular paycheck, it's pretty simple. You don't have as many slips. Filing your taxes is pretty straightforward. In retirement, you have multiple sources of income. Maybe I'm getting CPP, but I didn't get enough tax taken off my CPP, and I'm also getting OAS, and then at the end of the year, I actually end up owing money because you have enough tax taken off from these multiple sources. Getting that sorted could take a year or two. Reporting the right amount of income, getting the right amount of tax taken off, and then planning accordingly, that takes a bit of time. That's kind of the first mistake, all kind of bundled into one. The second item there is filing too early is related. Now, the deadline for personal taxes is April 30th of 2025. That's the file your 2024 return. That's no different than other years. Usually it's the end of April. But filing too early, and then you get another tax slip, and now you got to make an amendment, and it's a pain, and your accountants hate it, and it's chasing things down.
Yeah, big time.
That is a mistake we often see, and it's related to the first one. So you get in that routine, maybe you just have an RSP contribution, you just have a paycheck, it's easy, you can file in February when you get your T4 and you're done. In retirement, that might not be the case. Multiple sources of income like we talked about, and then a big one is you're now drawing on your investments. You could have different types of investments, and that could create a whole new bundle of slips that you got to track down that come in at different time periods. That's usually the reason people end up having to make an amendment and end up making an issue. It's because they missed one of those investment slips. So let's tackle those.
You've been sitting there for years and you've just been accumulating everything, so you haven't had to worry about these. And as Clint mentions, I mean, these are things that now you got a whole bunch more tax slips coming out, and you may not be aware of the time frame when they come out, whether you ever want everything at the end of February, everything at the end of March, is it going into April? Those are things. But when we start looking at the investment accounts, I mean, your registered accounts would be your RSPs, TFAs, your LIRAs, LIFs, RIFs, PRIFs, FSHAs, variety of different mnemonics for that. And then the non-registered ones would be your joint accounts, your cash accounts, your margin accounts. These are all ones that are going to have different sort of scenarios. Your registered accounts, of course, depending on what they are, if you're taking money out, it's going to be added for income possibility. Your non-registered accounts, you may have different ones that are earning dividends. They may be earning interest. They may be earning capital gains of some format. So a variety of these different options are going to give you different tax slips, and they all come out at different times. So again, in your investment account, the registered ones, I mean, your T4, your T4 RIF may be something to look at, your RSP contribution, your first home savings account. Those are probably the ones you're dealing with on your investment side of or on your registered side of the things. And then you go on to the non-registered side, which is going to have even more difficulty with some of these things.
Usually the slips on the non-registered account side is where people get tripped
That's where it is.
If you just have an RSP or a RIF, it's a little more straightforward. The non-registered account, which sometimes is a joint account, sometimes people use the term cash account or margin account, all kind of falls under the same umbrella. Non-registered account. That's where the slips get a little bit more confusing. You can get a T5 statement of investment income, a T5008 statement of security transactions. If there's buys and sells that take place, you would get that T5008. T3 statement of trust, that's one that usually trips people up, and we'll talk about that. Same thing with the T5013 or 5013, pardon me, statement of partnership income. Depending on the type of investment determines the type of slip you get, and then we'll pull this up. This is really the key piece here. We're not diving deep into all the different slips, we're just kind of mentioning them, and then this piece right here. Why do often people make the mistake of filing too early? It's because they get the dates wrong for the slip. Some come out end of February, some come out end of March.
And that's the big factor to remember. So, I mean, if you're dealing with a T4 RSP, a T4 RIP, basically anything that's that registered account, they're going to come out at the end of February. You're also getting your T5s and your T5008. Those are the easier ones to calculate. Whereas T3s, which become that statement of trust income again, or the 5 T5013s, the partnership ones, some of those wait until some of the other things have been done at the end of February before they start reporting, which is why you won't get those until the end of March. So that's the biggest factor to remember is what kind of income are you getting? And depending on what kind of income you're getting, that's going to dictate where you're getting it. End of February, end of March. So you may not get these slips until easily into the beginning of April beforehand. And that's why you have to be concerned about where to go.
Yeah, and a bit of a guide, what kind of investments might have these trust or these partnership
That's a
slips,
big
the
one,
ones
yes.
that come out at the end of March. Now, again, it's only in a non-registered account, so if you own one of these investments inside of an RSP, don't worry about it. It's only if it's in that non-registered bucket. You could have real estate investment trusts, often called REITs or real estate investments.
Yep.
Flow through shares, things structured as limited partnerships, LPs are big there, even a mutual fund or investment structured as a trust. That's not an exhaustive list. That kind of gives you an idea of the type of investment that would end up creating a T3 slip or a T5013 slip. And those are the ones that come at the end of March, which means if you file too early, you miss that slip, it's a big headache.
Got to refile.
Also, to help avoid this mistake, and that's the goal here, mentioning the mistake and how to avoid it, who sends these slips and how do you get a copy of them?
Well, that's the biggest one. Who sends the slips? Well, it could be your investment institution. If you're dealing with them, they're going to send out some slips. But by the same token, it may be the individual company that has to deal with it. And in the case of most mutual funds, it's usually the mutual fund company that will send you this slip. So again, it could be a variety of different sources that you want to get them from. And you're not going to get copies of these if you don't have them originally until they've been issued. So you might be able to get it from your investment firm if it's been issued, whether or not it comes from them or the mutual fund company. But again, once they've been issued, you can then go to your CRA account, at which point they'll all be listed on there, and you could probably get copies from there if you haven't received them. Not a bad place to check.
And that's a very good point. Once these are issued, and it is the investment company, not your advisor or planner, but the investment company that creates the slips. If you want a real estate investment, the real estate company creates the slip. But once it's created, it is filed with CRA, so they're going to know about it. And you could go to your CRA account to get a copy. That could happen as well. Important, lots of nuances here when it comes to tax slips and tax items. If you have questions, how do folks get a hold of us?
You go to chatwithclintonandkevin.com. By all means, you can go there, ask us anything you want on some of these last-minute tax tips. We may be able to help you find out where or when they're coming around. Or if you have any other financial matters that you want to deal with, by all means, send them in. They come directly to Clinton and myself. We'll get back to you as fast as we can just to make sure that we're answering your questions. And also, we have another portion on that.
Newsletter. If you like videos like this, we have a newsletter with similar tips when it comes to reducing tax, financial planning, retirement. We send it out every week. It also has invites to our free webinars. So if you want to attune one of the webinars, you sign up for the newsletter. You can do it on our website or the link in the description of this video. Click that guy if you want to be part of the newsletter community. Third tip here is missing tax credits. We talked about three. We talked about not reporting all the income, talked about filing too early and how the tax slips can be a big part of that. And then missing tax credits. That's the third tip.
I mean, that's the biggest factor. A lot of people are missing tax credits. You might have filed too early. If you do have a missing tax credit, you're going to get it in. You're probably going to have to refile again. There may be a cost to do that. So waiting until you think you've got everything or making sure you're checking that CRA account is the best way to do it. So less concentration now, but it can still be an issue. Most accountants nowadays, based on the software and everything else, normally will catch it for you. But I mean, there always may be one or two that slip through or something that's been missed on it. So you want to make sure that those last minute mistakes are avoided, missing those credits, and make sure you check your CRA account. So it may not be done in February. You may have to wait till April, but that way it's going to be easier to catch.
Yeah, and these kind of tax credits, and we'll have a list here of the ones we think are common for retirees. It may not apply in your exact situation. Most tax planning software or accountants will catch these automatically for you, but good to be aware of them to make sure they are, in fact, being taken advantage of. For example, you could have the age amount. If you're over 65, you could get a credit of up to $9,000. That's if your income is below $45,000. If you have income above $45,000 but below $105,000, you still get an amount, but it's reduced. Pension income tax credit. You have money from a defined benefit pension or coming out of a RIF, you can get up to $2,000 of a tax credit there. Disability tax credit, that's another important one. Get up to $10,000 of a credit if you qualify. Also, caregiver credit, medical expenses. There's lots on the list there, including the home accessibility tax credit, which if you do qualify for the disability tax credit, or if you're over 65 and you're making some renovations to the house, well, you could get up to a $20,000 amount you could claim for those renovations.
That's perfect.
Not an exhaustive list, but certainly look into those and make sure if they apply, you're taking full advantage, because it is a mistake we see.
It is
the credits are out there and people just aren't grabbing them, even though they qualify for them. And that's a list we think would be applicable for most retirees. If you like this video, there's one on the screen right now, all about why folks that are single in retirement pay more tax and what to do about it. So click that guy. We'll see you again very soon.
Take care.